There's a message in today's show.
I know you're excited, but calm down and listen to me carefully.
That's part of it. Here's more of it.
The longer term case is still there. The short run, a lot of stuff can happen in the short run. There's a lot of uncertainty over 6 month, 12-month type periods. But if you're going to buy stocks for 10 years, I think they're going to be higher, and I think they're going to do close to 5% after inflation.
That's Jeremy Schwartz, Global Chief Investment Officer at WisdomTree, co-author of Stocks for the Long Run. And in an extended big interview, he gives you plenty of reason to be optimistic about the long term without turning you particularly pessimistic about what's happening now. But first, Tony Turner, president of the TrendStar Group, is here talking technicals. And while her view is formed more by the charts and the numbers, it's very similar to what Jeremy Schwartz is seeing. Plus, we've got David Goodsell, executive director of the Natixis Investment Manager Center for Investor Insight, talking about their 2025 Global Retirement Index, which evaluates 44 developed countries to try to see which provides the best environment for retirees. And it may make you want to retire someplace else. Let's talk about it. Welcome to Money Life for October the 7th. I'm your host, Chuck Jaffe. Thank you so much for joining me. We have a great show planned and executed for you today. A lot of market talk, some really good evaluating what it takes to be in a place that supports you as a retiree. Good stuff to consider when you are reading the headlines, if you're reading the headlines about the government shutdown and what's happening with Medicare and Medicaid and a lot of those other sorts of questions, because without giving too much away, I will simply point out that the U.S. is in the middle of the pack of the 44 countries. Yeah. So if you're hoping that we're going to be the exceptional place to retire, not according to this research. Now, that doesn't mean you want to pack it up and go someplace else. And especially, I'll leave it till David is here to tell you what place is number one. Although, if you've heard us talk about it in the past, because we have talked about it in the past, it hasn't changed much. Like the top place to retire is in Scandinavia, and it's been pretty much the top place to retire for a long time. But that doesn't mean you want to go there. It just means you want to consider, to me, a lot more about what they have to support folks and what we maybe need to do to create an environment where you say, okay, I can have a good retirement. And by the way, you can have a great retirement anywhere. Like, don't think, because something says this is the place to be, that you have to go there. It's more, look at the terms and conditions. And I say this because we as individual investors have a lot of ways that we can make our retirement better. Maybe it's about when you're taking your Social Security income and can I do something to maximize it? Maybe it's about, am I annuitizing some of my savings so that I have consistent income so that I am not worrying about how I'm paying the bills and will my money last me long enough. Instead, I have made sure that I have an income stream that is sufficient. There's a lot of things that you can do. I know people and I've talked to people, and I know we have a few in our audience who are expecting. I've talked to some expats. I know a couple of others who expect to be expatriates when they retire. And there are a variety of reasons that they do it, some of which is they're making their money go further and they feel they can live in another place and do that better. I took a vacation now about a decade ago with my daughters to Mexico and spent a lot of time talking to folks who were expats who were living in Mexico, where they felt they were close enough that they could get back to see kids who lived in California and what have you, but they felt that the cost of living was a lot better and they were struggling with medical care in this country. They weren't struggling with it in Mexico. And you could say, but wait, the medical care here, wasn't it better than the medical care there? Well, they were debating what would happen when they needed more advanced care, but at that point they weren't. And think about what's being discussed. And I can tell you, as somebody who, when I lost my job at MarketWatch and I went out on my own, the Affordable Care Act was a godsend. And I say that knowing that I was spending a fortune on my health care. I was getting brutalized, but I knew how much worse it would have been. And so, it's one of these things that you can look and say, well, I don't know if it's that much of a problem if you change it. I can point out that Gail and I joke about it, that when we got married, I got her health care. and that it was worth a lot of money for me to marry that woman for that. And so she always says, yep, I married you for your cooking. And I'm like, and I married you for your health insurance, which is not the truth, but both things were strong benefits of the relationship. So I think it's a good discussion to be having. Now, of course, the market discussions we're having today, it's never a bad time to be talking about the market, but we have a great guest in Jeremy Schwartz, who is co-author with Jeremy Siegel, also from WisdomTree, on Stocks for the Long Run, to take a long-term view in a market that has short-term turmoil, even as it's at record highs, right? I think what is pushing things forward right now is a combination. It's sort of both extremes of the story. We always talk about fear and greed. Well, right now you've got the story that is, here's the warning of why something could be happening bad, and then there's the flip side of that. Here's the good news that could be coming out of it. So that's what we're looking at. You can reach me at chuck@moneylifeshow.com, and I'd love to hear from you. But right now, I'm betting you'd love to hear from our guests, so let's get to it. We'll talk technicals to kick things off, but it's a great lineup, and it all starts right after this message.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Don't get technical with me. But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals on Money Life, where we do demonstrate that the technicals, the charts, the patterns, they do matter. They help you determine what could be happening next and how you might want to respond to it. And one of our favorite people to talk technicals with returns to Money Life today. Tony Turner is president of the TrendStar Trading Group. She is the author of Invest to Win. She is also the author of A Beginner's Guide to Short-Term Trading and A Beginner's Guide to Day Trading Online. And what I will tell you about Tony is that if you want to learn how to trade, she is somebody who you want to know about, because it is all very common sense based. And it's not about, hey, you're going to trade to, look at the big money you're making at the end of this. It's much more about, let's do the right things, control the losses, etc. By the way, second editions of A Beginner's Guide to Short-Term Trading and to Day Trading Online have been out for a long time. But if you want to find more information, TonyTurner.com, or find her YouTube channel, which is youtube.com/@Tony, Tony with an I, Toni, Tony Turner 4095. And you can check out The Market Now. That is her video, basically goes out every weekend. Tony Turner, it's great to have you back on Money Life.
Hi, Chuck. Thanks for having me.
We start with a market that keeps going. Government shutdown doesn't seem to matter, et cetera. We're at record highs and flirting with record hires. So is this a case of the trend is our friend and keep riding it? Or is there anything out there that's making you nervous right now?
Well, Chuck, I think the one thing that's making me nervous, and perhaps some other people that I know in the business, is that this is something that you don't see. I mean, I've been watching stocks on a daily basis, some of them 5-minute charts all day, for almost 25 years. And maybe it's not a good thing, but we start to get a little like, are you kidding me? This is, quite easily too good to be true. I mean, the 14-day RSI is getting overbought again, and the S&P 500 is up nearly 40% from our April lows, and the NASDAQ's up even higher. And this is the part where our stomach grips up and we say, oh boy, can this keep going? I hear a lot of guys and women on CNBC too saying, this feels like 1999, and it keeps going up. So if you jump out, then you wish you hadn't. So technicals and history and what we always thought of was common sense, they're all kind of beating us up here.
Yes, but as you look at them, okay, this feels like 99, but does it have to have that ending? Like, there are definitely people who think we're inflating a bubble, but not a bubble like the 99 bubble, a bubble that means a 10 or 20% correction. Like, would you look, I had a guest use the word healthy correction on this show just a day ago. Would you be looking at 10 or 20% and going, Yeah, thank goodness. We needed that. Let's go. Or would you be looking at 10 and
absolutely.
20% and thinking that's a start?
And there's also another simple, traders take profits when it gets higher. A lot of people, I got 20%, I take my profits. And so it would be normal and natural right now for this market to move down a little bit. I mean, third quarter earnings season starts a week after this. Is everything going to be perfect? No. Could it go higher? Absolutely. This is just a kind of an unusual market in that we haven't had a pullback yet when a lot of us thought we would, because that's what always happens. It is overbought, but it's been overbought and it keeps going higher. It's an unusual economy, especially with all the new things, obviously, that have been happening in technology and AI. With all of that, that's unusual kind of events. And so we're all just kind of standing on one foot and another, waiting for something to happen. Maybe it won't. Maybe it'll just keep going. One thing I know for sure is nobody on the planet knows where the stock market's going to go tomorrow or the next day or the next day. Nobody. We take educated guesses, and that's as good as we're going to get. So what I like to do is just keep moving my protective stops up on my short-term trades, and of course, letting them be a lot softer on my longer-term, my investments, trend trades and investments long-term. So I want to stay positive with a neutral thing in my head. One day down isn't going to make me sell everything, and I wouldn't be surprised to see a 10 or 20% or 15%. Well, we want to call it a pullback here, or a little bit of a breather.
From a strategic standpoint, the problem becomes in a YOLO world, you only live once, as you pointed out. Well, you're afraid of missing out. But from a profit-taking standpoint, you live more than once. You live to take the next profit. You live to reposition, et cetera. So how much for you is this about repositioning? Use limits, trailing stops, whatever it might be, so that if something bad happens, you're not getting too badly hurt.
Last week, I was getting nervous about the market going higher. So I told a lot of my people, look at the XLU, which is the S&P 500 Select Utilities Spider Fund, because utilities is a lot of times where we go when we get nervous. And the thing took off like crazy. And now that's way overbought, because actually, if you think it through, and I did, power is what this economy needs, especially with AI to move ahead, to go forward. And utilities, which are usually ho-hum, took off. It was kind of humorous. And I thought, oh my gosh, now I got to have a protective stop on the utilities. It is all beautiful right now, Chuck. Being in the market as long as I have been, and I'm holding my breath a little bit.
Out of curiosity, when we talk about people saying it looks like 1999, the internet bubble, does this feel to you like 1999? Like in 1999, were you, it's all beautiful, but I'm holding my breath a little?
I wasn't holding my breath then, quite honestly, because that's when I started in trading. I had been an investor. I had done very well. I had been an investor since 1990. And with the help of some very good professionals, I had done well. I have a natural high risk tolerance, or I used to. I still do. So honestly, with you in 1999, I was in a trading room in New York with a whole bunch of guys. Whoever made the most trading that day bought the beer that night. But the people around me that did understand trading or short-term moves, I know that they were holding their breaths back then. And then we saw a double top form on the NASDAQ and the S&P 500. That's when I learned what double tops mean. And then, of course, it headed down pretty fast.
Is there something you are looking for here specifically that would be, there's your sign that trouble has come to roost? Or conversely, is there something that if you saw it would say, oh, okay, I can breathe easier?
For me, it's really, really simple. As long as the SPY, I'm going to call it because most everybody can get that on their charts. As long as the S&P Spider ETF, the SPY, as long as that stays above the 20-day moving average, which is a common moving average, as long as that stays above the 20-day, which it's been doing for quite some time, if it can do that, I'm breathing fine. Actually, I'm going to give it to the 50-day moving average, which a lot of institutional professionals use as well. The 50-day moving average right now is coming in at $648 and change. The SPY, of course, is hitting pretty much a new high today, kind of in line with Friday, but in much. So if the SPY starts heading down toward the 50-day or goes below the 50-day moving average at 648, then I'm going to start saying, okay, maybe some profit taking is coming in here. We never know when a black swan is coming in, but heck, it could be a long, long time before that happens, an exogenous shock type of thing. So I'm good. As long as it's above the 50-day moving average, I will breathe easily. If it starts down, then I want to get wise. And if I miss a little bit of money by taking some profits, it's not about how much money you make in the market a lot of time. It's about how much money you don't lose. And it depends on your goals, too. If I'm 25 years old and I bought Microsoft, I'm certainly not going to worry about it. If I'm someone who's, let's call it over 70 years old, then I don't particularly want to ride out a 20 or 30% loss on any of my stocks. So it depends on a lot of things. How your outlook is a good one to have, and you know that.
Yeah, it does. And of course, as somebody who's in my 60s and who is a shareholder in Microsoft, I have to worry about that differently than I did when I bought it when I was a lot closer to being 25. Tony, great stuff catching up with you. I always love getting the chance to chat. Thanks so much for coming back to Money Life.
Thank you for having me, Chuck. I appreciate it.
That's Tony Turner. She is the founder and president of TrendStar Trading Group. She's the author of Invest to Win, A Beginner's Guide to Short-Term Trading, A Beginner's Guide to Day Trading Online. And if you're going to be a short-term trader or you're going to be day trading online, get a classic book. And those are classics. Learn more at Tony Turner, TonyWithAni.com. Money Life will be right back.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
Now let's take a look at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today, we are looking at the 2025 Global Retirement Index from Natixis, which is a comparative assessment of retirement security in 44 developed countries. And this is an interesting one because if you want to know what people are doing for, with, and about their money, well, you should be looking at where are they coming up with great retirement security, not only because maybe you want to go there. I know that there's a number of you in our audience who are thinking you're going to become expats when the time comes for you to retire, but also because this is what we should be maybe hoping for. Because, oh, by the way, the U.S. is distinctly not the leader when it comes to the Global Retirement Index. Here to discuss it all is Dave Goodsell. David Goodsell is the executive director at the Natixis Investment Managers Center for Investor Insight. If you want to learn more, im.natixis.com. Better yet, find David where we have him mentioned in the Money Life Show recent and upcoming guest page, or in our show notes for today's show. You'll get the direct link to all the details on the Global Retirement Index. David Goodsell, welcome back to Money Life.
Hey, Chuck, it's great to see you again.
So those expats, the people who are determined to retire someplace else, where in the world should they retire to?
Well, our index tells us that the places that have the best kind of balance for retirement security are Norway is number one, number two is Ireland, and number three is Switzerland.
And Norway, Norway's it. They pretty much lead every year, but help us understand what it takes to be a leader when it comes to the retirement index. You guys have a number of different metrics and basically 4 sub-indexes. So what goes into it?
Well, we really try to ask these questions of basic interest to retirees. Can I afford to retire? Am I going to have access to good quality health care? Is the economy sound so I can count on predictability of what I'm doing? And the other one, too, is just what's my quality of life going to be? So we look at those factors all around, And what we tend to find is smaller countries have a better balance of those. That's why you see Norway, Ireland, Switzerland, also Iceland is in there, one of the smallest that we see. And the reason for this is it's probably easier to get consensus on all these issues that matter. So if you're talking about interest rates, you're talking about healthcare, you're talking about all these other issues, they tend to have a better way of getting to the point.
When it comes to the large countries, the only one of the large nations in the top 10 is Germany.
Right.
So we need to kind of figure out, why is the US not higher? Where is the US ranked among the 44? And why is it not higher when we consider things like our standard of care potentially so high?
Well, I think we look at a whole range of factors here. This is the point, though, you hit it on nail on the head. It's harder for larger countries with more diverse populations, more diverse issues that they're dealing with, to get to consensus on these core issues. So Germany, yes, is the top performing large country. Behind that is the UK and then the US. So while we're 21st overall, we're in the top 5 of the top performing big countries as well. So kind of have to look at it in those scales.
For somebody who is looking at living around the world and retiring to any of these places, and I recognize that you're looking at other factors and not necessarily how easy is it for someone from here to retire over there. But, you think about the things that are in the headlines here when it comes to healthcare and what have you. If you're talking about, how the health systems are set up, can you move to most of these countries and be like, okay, how long do I have to be there before I'm covered by their healthcare system and get the benefits that their population gets from living there? Or do they have the same issues with people coming in and taking up their healthcare resources that we have here?
Well, to be honest, we don't even look at that. What we're looking at is the availability for individuals within that country. It's a comparative tool that lets, say, a policymaker look at where they can help improve retirement security for folks. So when we look at the US, for example, we've got, great access to healthcare. We have, the problem that we see is that uninsured health expenditure is climbing. So it's a challenge on that front. I even look at the other side of this is one of the big issues you have to look at in these countries is not so much the pension system itself, but what impacts it. And that is the aging population. So you look at some of these countries like Japan, and then look into Western Europe, there are increasingly more older people in the population than younger people. And if you're going to make a pension system work, you need more people paying in than taking out. So this is a place where the US actually stands out pretty well, because our old age dependency is significantly lower than some of these other countries. That's a good sign when we talk about Social Security, we talk about all of those issues. So it's really that the interesting part is trying to find how you balance all of these issues and find security that way.
This is something you guys do every year. As you pointed out, Norway pretty much always at the top, and there's a little bit of change in those top 10. But what are the areas where the US could do markedly better, where change is really possible? Because most of the change here is glacial.
It's interesting you say that. It's not as glacial as we think, though, too. For example, Ireland and Iceland, when we first started this, were really low on the list because they had problems in their banking systems. As soon as those banking systems were kind of straightened out and they got their finances in order, they shot right back up into the top 5 or 6. So it's a question of really finding that opportunity to find the levers that work. No one's going to be perfectly balanced all around all the time, because there are things that change. But these countries that are able to kind of create that balance over things is where it really happens.
Are there places on this list that really surprise you? And maybe it's not at the top of the list. Maybe it's more likely to be, here's who we tend to have a good opinion of, but oh, by the way, retiring there would maybe not be such a good idea.
To be honest, we've been doing this for 13 years. None of this really surprises us. What does surprise us are the factors that move countries ahead and behind. And then many of these things are, very small movements that create this problem. One of the things we saw this year, for example, Singapore had always been in the bottom tier of things, moved up into the top 15 or so, predominantly around some of the things they were doing in terms of their finances. With interest rates and inflation coming under control, they were able to move up forward on that. That's an interesting kind of proposition. Very small country, very small factor that moves them.
Yeah, that is very interesting. And of course, the flip side of that would be presumably if they can't keep inflation under control, et cetera, they could swing back around quickly. And I don't know that anybody who's looking to retire wants to be in an environment that's changing very much.
Right. That's the thing. You know, I think what this is good for is to make people aware of the different things that have to be balanced in their retirement plans. And we see from the people we spoke to in the US this year in our global survey, inflation is really on their minds. We see it coming closer to the targets for the Fed have set. But when we talk about it, it's one of their top fears about retirement. It's 40% of people say inflation is killing their dreams of retirement. The reason that's doing is it's eroding their retirement savings. It's making it harder to save, and they're looking at their investment returns and seeing that that is getting whittled away by higher prices overall. So it really does factor into how people are feeling about their retirement.
Yeah, because it doesn't seem to make a difference no matter what home country you're in. People basically are finding retirement security is a bit scary almost everywhere.
Yeah, it's a challenge.
Beyond the inflation factor, what were the other things that you found from the individuals in terms of what they most need and want to get any sense of security about their retirement?
Well, I think the thing we see is there's this overriding fear that they're not going to have enough to enjoy their retirement. That's the number one fear around the world. Along with that, though, there's concerns about whether their government benefits will get cut. And I think, timely that we're talking about the public debt issue here in the US right now. We see that 3/4 of the people in the US are worried that high levels of public debt are going to result in lower benefit payments over time. And that's really an overriding fear. And if we think about it that way, that's why we're seeing about 80% of people are saying that it's increasingly their responsibility alone to fund retirement. We always talk about the idea of having a pension, having government benefits and personal savings. Well, pensions aren't so much part of the equation as DC is now, defined contribution plans like 401ks. So now you've got two pieces coming together to make that puzzle work. And now they're worried about a smaller piece from the government benefit. So people are really feeling this pressure to save. Inflation makes it tough to do that.
David, great stuff. You make it easier for us to understand what people need to do. Thanks so much for joining me on the show to talk about it.
Thanks, Chuck. Glad to be here.
That's David Goodsell. He's executive director of the Natixis Investment Managers Center for Investor Insight. And if you want to learn about their 2025 Global Retirement Index, go to im.natixis.com, or better yet, go find the direct link. It's in today's show notes. It'll get you straight there. And I may or may not ever retire, but I know I'm not retiring on today's show yet. So we'll take a quick break, be back with more of Money Life.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Welcome to the big interview on the October 7th edition of Money Life. Returning to the show today, Jeremy Schwartz, Global Chief Investment Officer at WisdomTree. And at WisdomTree.com, well, you'll find everything that they're talking and doing, etc. But when I say you'll find what they're talking about, I can tell you that this is one of the rarest things that has happened to me because I try very hard not to prep too much by ever following somebody's ads or statements. However, probably because I was prepping for this interview, at one point, I kept getting things from WisdomTree going, make sure you look at our outlook for the rest of 2025. And I actually clicked through on it. So I'm telling you, without telling you to follow the ads, that, yeah, the outlook that they printed for the rest of this year is worth taking a look at. But we're also going to dig into it. Jeremy Schwartz, it's great to have you back on Money Life.
So great to talk to you, Chuck. Thanks so much for having me.
Yeah, I'm trying not to feel like, I followed the ad and that led us to this interview, because that's not really what happened. But since I've prepped it that way, why don't we talk about, you guys did do an outlook that kind of was an early look at the rest of this year and, more importantly, into 2026. Let's talk about where you are with that and where things stand to you right now.
Well, I think the big story for the markets, you've got, in some ways, from a tech perspective, AI is dominating all the narrative. So where are you in that AI cycle? But also the Fed has been a key sticking point for sort of the broader participation of the rally. We think the Fed should be lower. You've got now this debate with Stephen Moran, the new Fed governor, out there saying he'd like them to go quicker. He called for a 50 basis point cut sooner. And, we do think they should be lower, that the Fed's been a bit too tight. You haven't really seen it in a major pickup in unemployment, but we would like the Fed to be lower. I mean, we think the Fed funds should be 100 basis points below the 10-year. Today, it's exactly flat. So usually you have an upward sloping yield curve where the short rate is lower than the long rate. Today, they're basically identical. So the Fed should be on path to lowering, continue. It's nice we got a cut. We think they're going to continue to cut. And, what that means is, what's been held back is the broader stocks beyond the Magnificent Seven AI winners. So small caps starting to participate in sort of the broader rally. We've been saying they need rates to come down, and we need to see them use AI to their benefit so that margins go up. And then, at the beginning of the year, you had this rotation to non-US. It's the first time in like 15 years, you started seeing a crack in the US exceptionalism narrative. It was sort of short and quick, but we do think there is something to that. And we've been saying I've been saying this for, I'm sure we've talked about this in the past, about Japan being one of my favorite markets. And we had an election over the weekend, a surprise election over the weekend that is, I think, it sent Japanese markets up 4% plus on Monday in Japan after the election. The yen is down a bit. It goes into all sorts of questions about how to play Japan. But to me, that's still one of my favorite markets. We could drill into that in more detail if you want.
I do want to drill into that, and we're going to drill into it in a moment because I want to finish your thoughts on the Fed. You said you believe the Fed should be further along than it is. But of course, since the Fed made its cut, we saw some changes in economic conditions, which have some people thinking they're going to make the next couple of cuts, but we're maybe not still going to get where we need to get to or should get to. So one, are you in the camp already that the Fed is maybe rethinking the cut schedule? And two, will these cuts give us the kind of response we normally expect to get from rate cuts? Because the last rate cutting cycle, we didn't quite get that broadly on the economy. We got some of that for the market, but we didn't get it for the economy.
Well, what's good about now at the Fed, you got a loud voice with Moran going in saying, hey, we should go 50. And so you had so much consensus thinking at the Fed. That was kind of problematic. So we're definitely happy Moran's got a seat at the table and he's talking about the more aggressive actions. Reality, we haven't seen a dramatic pickup in unemployment. It's been now we're growing employment much less. Now, some of that is just the realities of less people coming into the country. So, Powell's talked about 0 to 50,000 might be the new baseline, new normal of what is the stable job growth. And you've seen that sort of been the more recent trends in the numbers. And so now, and then there's this uncertainty about how productive are your people going to be with technology. And so you have this like no hire, no fire type of mentality where the people on continuing unemployment claims are being higher than normal, but not a huge push of new unemployment claims, and so that's kind of the new baseline. And so, we're not worried about a recession today, but we're worried about them staying too high for too long, creating that downside. We don't see inflation as an issue. Our sensitive indicators, like we look at the money supply very closely, last 12 months, 4.7, 5.5 is like normal, like 5 to 6% is 2 to 3% growth in the economy, 2 to 3% inflation. We're not even hitting 5. Checking deposits are even less than the money supply, only 3.5%. These are not inflationary indicators. So the Fed can continue cutting, remove their over tight path. And, I think the optimistic case is we're still just scratching the surface of what will the new technologies do for productivity and profits and margins. And you could be where we have softness in jobs, but still a robust growing economy. And I think that's still part of our medium-term outlook, you would say.
I won't say I made a mistake in the introduction, but I focused on your job because, of course, you are the Global Chief Investment Officer at WisdomTree. I did not mention that you are the author of Stocks for the Long Run, which for those who have not read it, I believe it's now in its 6th edition, which means there's probably a 7th one coming. Stocks for the Long Run, for anybody who doesn't know it, is kind of the Bible for buy and hold investors. this market in these conditions, there are a lot of buy and hold investors who I talk to who are similar to me. I'm in my early 60s, and the thing that scares me the most is sequence of return risk, is what are we building, et cetera. Are you worried with the conditions you are seeing? Because the economy and the market don't have to move in sync, that we can see a solid economy and still see some sort of bubble building or some sort of real problem. How much trouble is that? And does that impact at all what somebody should do if they're a stocks in the long run kind of investor?
Yeah, I've been working with Professor Siegel, who first wrote in 94. I've worked with him for 25 years. I started with him on the 3rd edition of the book just as an undergrad. He upgraded me to co-author on the 6th edition. So we've had a 25-year relationship. He joined WisdomTree as investor advisor, now our senior economist. So we've had a great long-term working relationship. I talk to him every week on my own podcast. I think that dynamic for equities, we were spoiled for the last 20 years, like the equities versus bond trade-off. The way we look at the equities versus bond trade-off is sort of what we call the equity premium. And we look at the earnings yield on the S&P versus the TIPS yield. The 10-year TIPS is, with the 410 10-year, 415 10-year, you're below 2% on the TIPS, which gives you very easy math. If you're going to go hide and shelter, if you're afraid about equities and say, hey, I'm worried a little bit about inflation, so that's the key risk to bonds, I'm going to buy a 10-year TIPS below 2%. That means in TIPS, it's going to take you 36 years, Chuck, to double your purchasing power. 36 years. We're living longer, but 36 years is a long time. In stocks, a 23 PE is below 5, so we're calling it 4.5% earnings yield. That is that earnings yield. We compared that again to that below 2% TIPS yield. We're talking doubling purchasing power every 14 to 15 years. At a 4.5% earnings yield, just doing it's sort of rule of 72. 72 divided by the growth rate, the earnings yield being a good approximation of longer term returns, real after inflation returns. So this is, not nominal returns, but after inflation returns. So doubling your purchasing power in 14 years versus 36. It's still a good case for stocks versus bonds over the long term. Yes, the PE is higher than normal. The normal PE we say is 20, which gives you a 5% earnings yield. That's lower returns than we show in stocks for long run. Siegel showed 6.5 to 7% is your long-term equity return. We think it's probably going to be a bit lower based on just higher valuations, but bonds are lower. Bonds used to do 3.5 going back 200 years. Now they're doing below 2, as I said. So, things are more expensive, but, the longer-term case is still there. The short run, a lot of stuff can happen in the short run. There's a lot of uncertainty over, 6-month, 12-month type periods, but if you're going to buy stocks for 10 years, I think they're going to be higher, and I think they're going to do close to 5% after inflation.
Let's turn for a moment to Japan. You mentioned it as we record this. Japan had big changes, got its market back to record highs. Of course, Japan was always the poster child for what can go wrong after the market gets to record highs because, it had a long period where it didn't get back and recapture record highs. How meaningful is it right now for the global economy and for Japan as an investment opportunity to be where it is?
Well, it is, 1989 was the peak of their bubble. It may have been the biggest bubble of all time in terms of equity markets. We think about tech in 2000 being our big bubble, but the Japan bubble in 89 was much more aggressive than the US tech bubble was in 2000. Well, so they're now reclaiming those highs. The S&P's at 23 times earnings. Some of Japan's indexes are like 13 to 14 times earnings. So you have a very different dynamic. You had, when you think about the US exceptionalism narrative I talked about since 2012, name me an international fund or strategy that beat the S&P. Broad international benchmarks did half of the annualized return for the last 13 years. Shinzo Abe came in at the end of 2012, December 2012. The S&P did 14.5%. Broad IFA did 7.3. I mean, the compound returns of 7.5 versus 15 are just dramatic. We're talking like 500% versus 150%. And you say, well, name me a fund that did better. DXJ, our currency hedge Japan, outperformed the S&P since Abe came in 2012. And then you had sort of meandering. They had some prime ministers that were not so exciting. Takaichi comes in as Abe 2.0. So she is in the mold of Abe. She wants to cut taxes, She's very pro spending. She's definitely a hawk on defense. So if you looked over the weekend, some of the defense stocks were up 10 to 12% or more on their Monday opening when she comes in and says, I'm going to spend a lot more on defense. So she's definitely more hawkish on the China relationship. And so we think one of the top themes is Asia defense. We launched an ETF, WDAF, for Asian defense that has Korea, India, Japan, all in sort of the spending. If China were to go after Taiwan in some ways, who's going to come to defend? This is a much more hawkish Japan prime minister that is going to spend in defense. And so she's revitalizing. We think she's going to revitalize the economy. She's got dynamics. It's not so easy. She doesn't have a majority and they're sort of in the houses. She's got to get more support for her policies, but the tone coming from Japan is going to be quite different. And to me, it's still one of the top opportunities around the world.
I am old enough to remember when Japan was peaking in 1989. A lot of what was discussed, and I think a lot of what people remembered back then, was they felt that was a time when Japan was eating our lunch, that their market was going gangbusters, and people don't seem to think that ours was. However, if you actually go back and looked, you would find that, in 1989, when their market was peaking, the US was up over 30%. And then as their market started to tank, our market tanked a little bit, and then we went pretty gangbusters into the 90s and the whole internet bubble. Do we move again, sort of opposite to them? Like, will we in any way see a step back if they see a step forward, or do we move in lockstep?
I mean, they are in the scheme of the global markets, the U.S. is becoming, actually very similar to, they were like 60% of the world benchmarks back then because their market cap had gotten, or certainly for the ex-U.S. benchmarks, they got up to 60%. They are of a global benchmark today, less than 5% of a global portfolio. When you look at people who do market cap weighted ETFs around the world, a passive index, it's like 2/3 of the US at this point. That is making a big bet on the US versus everywhere else. So it's not like they're going to come and rival the US in some ways, but from a forward-looking return perspective, I think they will. And like the valuations are lower. I think the growth rates are there. You've got Buffett buying Japan as a key narrative. Like, he's been one of the people who's brought more interest back to Japan than anybody. I've been saying since he first bought these Showa stocks, these trading houses 5 years ago. I've read about probably like 5 or 6 pieces over the last 5 years. Follow Buffett into Japan, and there's been a number of ways to do it. And we even had to create a strategy to get people almost half the exposure to the Buffett stocks, because Buffett's telling people, I can't own more of these stocks. I wish I could. I'm capped out at only 10%. And we created Japan Opportunities Fund to give people almost half the fund weight to those 5 Buffett stocks with some of these other defense names and other opportunities that we think are there. So it is a big idea, but it's been an undercovered, underloved idea.
If we're talking about leaning into Japan, what parts of the world can you not get behind, given where we are with trade potential problems, et cetera? Do you expect that, other central banks have been looser than the U.S., have moved ahead of the U.S., et cetera? Are we going to be in a spot where the rally that we've seen this year internationally continues, or do you think that's over because that was mostly a currency play?
Well, I do think about this currency question a lot, and for sure the dollar has been weak, and that's been one of the boosters for international. I've been a key advocate that you don't have to make international about the currency, and we do hedge and unhedged. In Japan, we have DXJ, the fully hedged. The Japan Opportunities Fund, OPPJ, that I just talked about, has more of a dynamic feature where it'll raise and lower the hedge ratio based on that market dynamics. I don't believe you need to go international for a down dollar play. In fact, on Monday, the weak yen was like the booster for the markets. Like that, a weak yen, if you're not hedged, offsets your returns. So I don't think that it needs to be all about the currency. The dollar has been weak. Gold has been surging this year. I mean, it's up like almost 50% on gold. And that's sort of some of that, another outlet of there's a lot of things going on behind gold with central banks buying it. ETF investors are just starting to participate in the gold rally. So you could look at, how do you stack gold onto portfolios in a different way than just relying on international? It's like, do you really want to bet on the yen, the euro, the pound as part of your driver's returns? Why are those going to be stronger currencies than the dollar? I don't know that I really want to bet on those. I think there's a lot of reasons why the dollar may be better, but who knows? It's just like a coin flip. So I know the stocks in Japan are cheap. I don't know about the yen. And so that argues for more hedging. And that's how Buffett bought Japan. He started issuing bonds in local currency so that he would hedge out his currency risk. That's another place where I said follow Buffett into Japan by following his currency dynamic there. But it's it's an open question. But I think the case for Japan is strong valuations, their revitalized sentiment, lower taxes, pro-growth initiatives that is very good for the stocks. Who knows about the currency?
You talked about Japan being relatively cheap, but of course, the market is at record highs. There's a lot of discussion here about just how good the value proposition is on domestic markets. As co-author of Stocks for the Long Run, which is basically that Bible for buy and hold investors and value investors, how do you see valuations right now? Because people say, well, it's pricey, it's at record highs. But yeah, it goes higher from record highs. That's often what happens. So where are you on valuations here?
Well, I think not everything is expensive. So if I took my US value fund, WTV, the PE on that basket is 13.5, and it's got a shareholder yield in the sevens. So these companies are buying back shares 5%, 5.5%, dividend yields of close to 2. You add the dividends and buybacks together, that's a 7.5%. That is downright above the Siegel 6.5 to 7% real return over the long run. That is 7% just from dividends and buybacks. No growth in these companies, and they typically are returning 7%. And that's been true for the last 7 or 8 years. So if you said you are concerned about valuations, I'd say look at WTV. It is a great, much lower price. Instead of 23 times on the S&P, 13 times on that basket right now, 7.5% total shareholder yields. Yes, the S&P is higher than the 20 that I think is long-term fair value. But when Siegel also wrote an op-ed when I first met him, I've been working with him 25 years. He wrote an op-ed in 2000, big cap tech stocks are suckers bet, March 14th of 2000, the day NASDAQ peaked, okay? Basically, within a few days of the NASDAQ peak, March 14th, 2000. At that time, there was 9 stocks with triple-digit PE ratios. From all, from Cisco, AOL, Yahoo, all these big, large tech companies, 9 stocks, triple-digit Ps. Of the Mag 7, who has a triple-digit PE? One of them, which is Tesla. The others are 30, basically. And, 30 versus 20 for everybody else, well, you understand why they're selling at 30. I mean, why is NVIDIA selling at 30? Everybody needs as much chips as possible. Now, you could say some are more expensive than others, like Apple's not growing at the rates it used to. Buffett's selling down his Apple stake. And you can say, is it worthy of the 30-ish type PE? But in general, it's not a major bubble. Like it's pretty well justified why the stocks are selling at the multiples they are. They all have execution risk. If they don't deliver their earnings, they will fall. But, you understand why they're selling at the multiples they are. And it's not some massive misplaced bubble like tech in 2000.
Given your comments there about Tesla, I'm curious because we've had a couple of folks say that let's stop calling it the Mag 7. Let's kick Tesla out. Are you Tesla in or Tesla out on the Mag 7?
It's interesting. We have a quality growth strategy that takes exactly a neutral position on Tesla. It's certainly the most expensive. So it's got, in some ways, the most relying on a far different future, but it's also hard to bet against Elon. Like he, has delivered on very big, bold, ambitious things. And there's a good reason why it's selling at this, very, very high multiple. So it's not relying on the car company. It's relying on the robots and sort of full self-driving going in much more places and the AI ecosystem with the robots. So I do see that it's possible. Like it's hard to really bet against it. And so in our quality growth index, we basically take a neutral position.
Which is a non-answer for whether it be the Mag 7 or the Mag 6.
Yeah. Well, no, it's a Mag 7. It's for sure Mag 7. And I'm saying I'm not willing to bet I'm not willing to overweight it or underweight it in that index. It's basically what we're saying. It's a market weight and we're not betting with or against it. If it goes up, it goes down. We're not betting against it is what I'd say.
Last question. As you start to look forward for 2026, we've had, if we were to stop this year right now, we'd be like, wow, we're on such a big winning streak. And there is the sentiment among investors, this can't continue forever. We need to take a breather or what have you. We haven't really gotten a forecast from you out of, when or if there will be a landing, but whatever trouble spots you see is the more important thing to take away, particularly as a long-term investor, that they will not be excessively long-lived. In other words, yeah, okay, fine. Downturns haven't been repealed, but they're not going to be the ones that you go, that was the Japan situation or something along those lines.
We're pretty constructive. I mean, I know it doesn't feel like it's early days with all the AI hype and discussion. And, we had the ChatGPT moment in 2022. Like, where are you in the deployment and rollout and net benefits? It's a very open question. Like, we don't know the answers, but I'd say the money you're seeing deployed against it tells you you're fairly early in terms of like real people benefiting, real, companies beyond just these chip stocks. Like, there's going to be massive dispersion of the benefits. And that's call it a secular tailwind to the markets and to companies and to earnings for a number of years. And, so I think there's a longer term good scenario. Yes, there's going to be hiccups and headwinds. There'll be uncertainty and questions, companies disrupted because their business model goes away. There's definitely going to be dispersion of benefits, but it's a broadly constructive story. And so you can say we're biased by our stocks for long run views. I think stocks for the medium term is a pretty good place to be. Next 5-7 years can be a good place to be in markets.
Jeremy, great stuff. I wish we had a little more time. We don't, but let's make some time to talk as we get into the new year and we watch it all play out.
Thanks, Chuck. Always great to be with you.
That's Jeremy Schwartz, Global Chief Investment Officer at WisdomTree. Go to WisdomTree.com for more details, find his commentaries and the work that they're doing, and more. And we'll be back to wrap up this edition of Money Life right after this message. Stay with us till the end, please.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
We are back to put a bow on this one. I think I kind of misstated it. Jeremy Schwartz is the co-author of Stocks for the Long Run. I think I just said he wrote Stocks for the Long Run, which of course is Jeremy Siegel's book. Jeremy Siegel is the chief economist for WisdomTree. Jeremy Schwartz is the global chief investment officer. So you've got that difference in what they do, and you have that difference in the book. It is presumed that at some point when Jeremy Siegel stops re-upping Stocks for the Long Run, that Jeremy Schwartz will take it over since he has been co-author since the third edition. But if there was any confusion, that interview was with Jeremy Schwartz, the Global Chief Investment Officer at WisdomTree. Jeremy Siegel, the original writer of Stocks for the Long Run. Again, Jeremy Schwartz has been his co-author for the better part of that time and was officially made co-author on the last edition, is the Global Chief Investment Officer at WisdomTree. Sorry for any confusion there. Sometimes you just get caught up in it all. Hey, tomorrow on this show, Cheryl Smith from Trillium will be here. That is always a good time. Coming later this week, Meb Faber, a couple of other interesting things. It has been a very crazy week, like a lot of cancellations for late in the week, which is terrible in a week when I have to go someplace, which I am going down to the conference on personal finance, the personal finance summit that Cebu is doing in New York on Friday. And so when I'm traveling, it makes things a little bit nutty, but hey, we'll figure it all out. And I promise you, it'll be worth checking us out, regardless of who I'm telling you is coming, because we do have some great things planned. If you're looking for something to celebrate, today is National Propane Day. It is National Inner Beauty Day. It is National Flower Day, and by that I mean flowers like flowers, not flour like what you throw into bread and what have you. And it is Bathtub Day. But it is also Taco Tuesday. Yes, the actual Taco Tuesday. Because today is National Taco Day, and it is held on the first Tuesday in October. So Taco Tuesday can be a thing. It's also a thing in the Lego movie, which I know you've heard me talk about before. But yes, Taco Tuesday would be today. But if you don't want to celebrate with tacos, well, you could celebrate with fruit at work because it is National Fruit at Work Day. You could have a chocolate-covered pretzel because it's National Chocolate-Covered Pretzel Day. And it is National Frap Day. And a frap is different things in different parts of the nation. Yeah, where I grew up, what we call a frap here in New England would have been a milkshake. Absolutely. But that is not the way it is in much of the country. So when it's National Frap Day, the interesting thing is I didn't see anything that actually gave us a definition, like a clear, this is what a frap is, because it can be different things in different parts of the country. But never a bad idea to celebrate any of those things, I don't think. My guests today were Tony Turner, the president of Trendstar Group. Go to TonyTurner.com, or she's at TonyTurner4095 on YouTube if you want to get her videos. David Goodsell is executive director of the Natixis Investment Managers Center for Investor Insight, im.natixis.com. Find the direct link to get to the 2025 Global Retirement Index. And Jeremy Schwartz is Global Chief Investment Officer at WisdomTree, WisdomTree.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Morgan Housel, who we hope is going to be a guest on our show next month. He said, a big takeaway from economic history is that the past wasn't as good as you remember, the present isn't as bad as you think, and the future will be better than you anticipate. And yeah, if the future is going to be better than you anticipate, it's one more reason to remember that until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and stay calm. We'll see you here on Money Life again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
I'll never forget this time we spent together. I love you, always.